One. I am going to wait just a few moments to watch as everyone starts signing in. I'm going to give everyone a chance to sign on. Participant number is rising, so I'll just wait a few more moments. All right. All right. Well, I think we're about there. All right, good afternoon, everyone, and welcome to another edition of our weekly Strategic Insight Live. Thank you all for tuning in. I am Karen Rowe, Development Strategist here at Waddell and Associates. For the next 45 minutes or so, David?
Yeah, you know, if they're in their best behavior.
So for about 45 minutes, our CEO and Chief Investment Strategist, David Waddell, will do a deep dive and deliver his macroeconomic outlook for the rest of this year. Most of you are very familiar with our firm and what we do. For those of you who don't know, Waddell and Associates is a wealth management firm dedicated to enriching life by providing clarity. I believe David does a great job providing clarity in these presentations and really cuts through the financial fog, and hence he is affectionately named the Fog Cutter. So before we start, I do want to go over just a couple of things. If you have any questions during the presentation, please go ahead and submit them in the Q&A chat area at the bottom of your screen. If we don't answer your question live, we will be sure to follow up with you after this presentation. You can also email us at request@waddellandassociates.com, or you can, of course, reach out to your wealth strategist here at W&A. There will be a video replay, which we will send out in our weekly email on Sunday morning. The replay will also be available on our website. If you don't get our weekly emails, let us know. Every week we send out high-level information on the current marketplace. You don't want to miss it. Again, email us at request@waddellandassociates.com and we will be sure to add you to the mailing list. With that, I will go ahead and toss the screen over to the Fog Cutter himself, David Waddell.
Thank you, Karen. Hopefully all of you can see me and hear me. Karen, can you verify that, or someone? Thank you. All right, so it's hard to believe, but this is actually the 4th live strategic insight we've had since the beginning of this pandemic. And I remember very clearly the fear and the urgency that surrounded our first presentation, which I delivered to you on March 20th. And I went back and reviewed that in advance of this, trying to figure out where I was in that particular moment. And I closed that presentation with a discussion that's still relevant today. It was a discussion of the juxtaposition between possibility and probability. And at that time, I said, look, I will acknowledge that it's possible that China has deliberately infected the world. It is possible that the economy will enter into the second Great Depression. And it's possible that we will all succumb ultimately to the coronavirus. That's possible. But what we see as probable, and remember this was March 20th, is that the market will bottom in Q1, that the economy will actually bottom in Q2, and that there would be a substantial rally off the lows that we were likely printing as I spoke. Given that we as money managers move money based upon what's probable and not what's possible, we placed our bets accordingly. Now, markets actually bottomed 3 days later, making that probably our most accurate prediction in our firm's history, which is fun, but it makes me nervous about the conversation we have today because I have an Icarus complex, you know. But that was then, and this is now. So today, I'm going to walk you through what our current view of the situation is, and again, what we assert as most probable, which again informs our investment decisions. Now, with any luck, the markets are going to maintain their obedience, but we shall see. That's what makes this business so challenging and so interesting. But before I begin, I want to take you back in time a little bit. And what I've done here to remind you is to size just how significant that drawdown was back when we had that conversation in March by comparing it against other significantly negative periods in the stock market's history within the US, going back to the Great Depression. So these are 30% drops in the S&P 500 and how long in days it took for that to occur. So when the tech bubble burst, it took 360 days for the stock market to fall 30%. In the great financial crisis, it took 250 days for the market to fall 30%. In 1987, remember the computers went haywire. That was known as Black Monday. It took 38 days for the market to fall 30%. And the roaring 20s came to a close with a gong when the stock market fell 30% in just 31 days. Well, in February of 2020, the stock market started a precipitous decline and actually fell 30% in only 22 days in reaction to the coronavirus. This is a big deal because the size and speed of this drawdown really became smelling salts for the Federal Reserve and also to Congress. And so the fastest decline in market history led to the fastest monetary stimulus response in US history. The US Fed cut rates almost immediately from 1.75% down to 0.25. It also opened the spigots again, started printing money, and ballooned its balance sheet up from about, call it 3 trillion to about 7 trillion, just an astounding advance to flood the marketplace with liquidity. Absolutely the most significant and fastest monetary stimulus response that the Federal Reserve has ever issued. On the fiscal side of the equation, this gives you some perspective on the size and the speed of what we received after I gave that talk, by the way, in reaction to the coronavirus. So here is how long it took and how much stimulus was authorized in response to the financial crisis. The financial crisis actually began back in August of 2007 when a couple of hedge funds inside BNP Paribas blew up. 600 days later, the US Congress authorized about 2 trillion in funds, okay, in different stages, and that's what I'm showing you here, but the cumulative impact is about 2 trillion. In response to the coronavirus, and this chart begins, 0 is the date of the first death in China. So not even the first occurrence in the US, but the first death in China. It took us a little over 100 days to get 3 trillion in stimulus, and there's another trillion in the works with the HEALS Act. That's very important, and we'll come back to that. But assuming that passes, we will have accomplished in a third of the time twice the level of stimulus that we received in reaction to the great financial crisis. Completely and totally unprecedented in the history of the United States. So the right question to ask, knowing that we had the fastest market decline, the largest amount of and fastest monetary stimulus we've ever received, the largest and fastest fiscal stimulus we've ever received, who will win out? Will all this stimulus work? Or will the economic impact of the coronavirus ultimately take us into yet another recession, if not a depression? All right, nice slide with some art asking the question to remind me. Yes, the question is, for this presentation, will it work? All right, you may recall this from earlier, but this is important. It is critical if you're trying to predict the future to have a command over the past. So let's get in the Wayback Machine and go review what happened in previous pandemics. We've had 4 previously, going back to the year 1900. We had the devastating Spanish flu in 1918. We had the Asian flu of 1957. We had the Hong Kong flu of 1968. And then we had a flu that nobody really remembers, but it was really infectious and also deadly back in 2009, known as the swine flu. So let's start with the Spanish flu. I have adjusted the population figures to reconcile with the 7 billion people we have on the planet today. So these are population adjusted fatality levels. But back during the Spanish flu, almost 3% of the global population died. I mean, it was an awful pandemic. Well, that would translate roughly into 214 million people today. During that period, which was also World War I, we actually, during the course of the infection, grew the economy by 10%. There was a drawdown in the stock market, but it was relatively benign. There was an 11% drawdown at the height of the fatality rate. But over the course of the infection period, the market went up 40%. Imagine that. So this was the worst pandemic, at least in the modern era by far, and yet we didn't have a vaccine. We didn't receive any stimulus. The economy grew by 10% over the period, and the market went up 40%. Okay, dog ear that in your mind. Let's go forward 30 years or so and talk about 1957. Population adjusted, 3 million people on the planet died. In terms of US GDP growth for the period, it was up 2.4%. We did have a recession. We did have a bear market. The Dow at its low was down 21%, but over the entire period, the market was actually higher by about 6%. We'll come back to the Asian flu. 1968, do you all remember that? I mean, a lot of us were alive. That was the Hong Kong flu. It was a pandemic. It killed 2.2 million people across the planet, population adjusted. Yet I think, 68 or 69, we had Woodstock. Nobody I talked to really remembers the Hong Kong flu, but it was deadly. In terms of US GDP growth during the period, the economy rose 3%. The max drawdown in the market was about 16%. Total return for the market overall was negative 10%. But if you go back and look at what was occurring during that period, the Vietnam War ended. The government was dialing in budget deficits, and so it was actually a restrictive period of austerity, and the Federal Reserve was also tightening as well. The nation went into a recession in 1970. It wasn't deep, but it mattered. So I think the drawdown of the market over the period was more correlated with what was going on with both fiscal and monetary restraint, and less correlated with what was going on with the Hong Kong flu. Nonetheless, those are the numbers. And then fast forward to 2009, we had 17,000 Americans die, I think, in the swine flu epidemic. Here, overall, 411,000 population died, but GDP had just come through. The great financial crisis was heading higher. Max drawdown, I don't think it was related, but it was within the period of 11% in the Dow. And then the total return, of course, in 2009 was substantial as we exited the great financial crisis and the accompanying recession. So here is what happened in the previous pandemics, both from a GDP perspective, looking at the stock market, and remember, in none of these periods did we really have viable vaccines. We had one during the Asian flu, which I'll talk a bit about, but no stimulus. It was really, these were stimulus-free environments. All right, so let's go back and talk a little bit more about the Asian flu. When the death rates were spiking, the market was tanking. So we did see a 21% drawdown in the fourth quarter of 1957. But again, as I stated, over the entire period, there was actually a 6% gain. In terms of the economy, this is a great analog because we did see in the first quarter of 1958 a consumer strike, if you will. There was voluntary quarantining, there was voluntary social distancing. None of that was mandated by the government, but you had pockets of it all around the country wherever the infection rates were spiking. So we saw a drawdown in GDP in the fourth quarter of 1957, and then we saw the largest drawdown in GDP at an annualized rate we had seen since the Great Depression. So very analogous to what we're going through here. Mandates were not part of the equation. The quarantines, the social distancing was all voluntary. And then you saw substantial growth in GDP once those animal spirits went back and did some shopping and went and acted as they do in the US economy as consumers with insatiable appetites. 60% of the people who received the vaccine were properly inoculated during that period. So we actually did get a vaccine, but it wasn't fully effective. Nonetheless, the economy came out of it rather strong. And the total drawdown in GDP from top to bottom was actually only about 3%. All right, here's where we are today. COVID-19 is what the doctors call it. I call it COVID-20 because that's when it really messed up, at least our portfolios for a few months. So the max drawdown during that period I talked about was 38%. That's pretty significant. I'm using the Dow here. That happened within, like I showed you, 25 days. But the total return now is only down about 0.5% on the Dow after today. So very similar to what we saw in 1957 playing out to the letter. We had a quarter in anticipation of economic and physical hardship where the markets drew down significantly only to rally back once we got in the mix. So one of the questions I always get is why does the market seem so disconnected from Main Street? They're never synchronized, right? The market's always looking forward. Main Street is what you're experiencing today. The market is what you're going to be experiencing a year from now. So the market's always a forward-looking mechanism. That's why they don't seem synchronized. They're never actually synchronized. In terms of the economy, very similar to what we saw in 1957, only exacerbated by the actual mandates. And so the first quarter, we saw 5% drawdown annualized in GDP. Second quarter was massive, largest we've seen since the Great Depression, with a 33% annualized slowdown. When you just take that from the top, we have a $20 trillion economy. We descended about 10% at the nadir, reached a month or two ago. That equates total to a 10% decline. So in total, we've lost a $2 trillion amount of GDP to coronavirus, right? The question becomes, what are we going to do about it? We have a $2 trillion problem. Well, the first to step up, as we've already sort of mentioned, was the US Federal Reserve. They said, look, we'll put $3 trillion of liquidity into the system immediately. But that's not all, folks. They also backstopped the credit markets with $4 trillion in loan guarantees. Now, this money actually hasn't been deployed, but what it's enabled is companies to raise money with the marketplace knowing that the Fed's there to backstop it in case any of those auctions fail. So the Fed immediately threw basically $7 trillion at a $2 trillion problem. And what they've done by doing it is something that's absolutely mind-blowing and historic and completely and totally informs the outlook that I'm sharing with you now. The amount of money supply in the United States of America, just lay it out on the table. If you've got $4 bills, lay them down. Lay one more next to them, and that's $5 bills. They have given us an extra dollar bill. That's an enormous surge of capital into the economy. This chart goes back to 1984, best year ever, by the way. But it goes back to 84 or somewhere close to that. And what you can see is that the Fed does sort of manage the amount of M2, and in reaction to recessions will jack M2 up. We've never seen anything like 25%, and here's why. And I've written about this, you may recall. If you're Federal Reserve Chairman Jay Powell, or any Federal Reserve Chairman, your nightmare each night is that you're responsible for a second Great Depression. Because the Fed did cause, if not exacerbate, or exacerbate, if not cause, the first Great Depression. The economy was going into recession back in the late 20s, early 30s. The Fed tightened money supply. And in fact, the federal government tightened fiscal spending as well. And that just augmented the size of the recession into a depression. They just didn't know what they were doing, okay? And then Milton Friedman came along and he taught us that the economy is nothing more than how much money is circulating and how fast it's circulating, right? So if money stops circulating, the only way to offset that is to print a lot of it, right? To flood the marketplace with it because it's not circulating. So total money supply times velocity equals GDP. So Jay Powell knew that velocity was collapsing. The only way to offset that was to create an enormous amount of money supply. That's what's happened here, unprecedented. But right now, we've got 25% more money circulating around than we had pre-COVID. And this is showing up everywhere, okay? This money is showing up everywhere. So this is a chart that takes the bond issuance in the first half of the year for large corporations basically and doubles it into the end of the year. So it's a prediction, it's probably overstated, but what it does demonstrate is just how much money has been pumped into the large corporate sector. So, you know, what would have been a record at about 1.5-1.7 trillion in total bond issuance could be up as much as 3. So large businesses are absolutely flush with cash right now. Now, small businesses are where the damage is within this economy. And typically what happens within a recession is that the yield curve inverts, the banks stop lending, small businesses go into duress, you have rising bankruptcies. That's the way recessions work. And you can see that in this chart. The lighter area on the chart is correlated with recessions. And you can see the commercial and loan activity at commercial banks collapses in recessions, except for this one. In this one, the amount of CI&I loans have actually gone up, you know, nearly 30%, okay? So small businesses may not be doing well, but they do have access to capital. So cash is available to small businesses just like it is to large businesses. And what about investors? Well, investors are flush with cash, right? Retail investors have a lot of cash. Institutional investors have a lot of cash. There's plenty of cash on hand in investor accounts as well, earning next to nothing, trying to figure out where to go. So now what we've got is we've got the Fed that's made sure that there was plenty of liquidity flowing in the system, backstop the bond markets to make sure that those in need of credit could get the credit. But what the Fed cannot do is compensate people directly for job losses, right? And as we know, as the economy hit a hard stop, corporate revenues went down, layoffs went up. That is an immediate problem that the Fed cannot solve. And so here we are, I'm showing you the layoffs. We went from basically a 3% unemployment rate, which was a historical low in the United States, and minorities were doing well, and people with limited educations were doing well. It was a really robust economy. COVID hit, unemployment went to 15%. The government went, uh-oh, we got to do something. And they were right to act because a job is nothing more than a vehicle to receive personal income. So while the unemployment rate is an interesting number, what matters ultimately is what's going on with personal income, right? Because that's the fuel that gets spent as consumption to lift the economy. And personal income, because unemployment went up to 15%, was slated to shrink 7.25%, which is a devastating decline in terms of personal income. So the government said, you know what, we'll step up here. And so we got $3 trillion of fiscal stimulus. Much of that went into payments directly to taxpayers, handsome payments, you know, $1,200 plus a stipend per kid, which I forget the first bill was $500 or whatever. So a household could get 12 plus whatever they got for the kids. That's a huge infusion. Additionally, as we know, and is being hotly debated now, those who were unemployed received a stipend from the federal government of $600 to complement what they get from the state, which could be, call it $250. And so you were getting $850 a week if you were unemployed, which for 66% of the people receiving that money was more than they were making on the job. That's astounding, right? Now, when you factor that in, what you find is that personal income, including those stimulus payments, actually went up 11%, right? So 15% unemployment rate, but yet an 11% raise for everybody operating within the economy. That's astounding. And the switch, remember, non-stimulus would have been a 7.5% decline. With stimulus would have been an 11% raise. It's only almost a 20% swing. It's just unbelievable. So the question is, what are consumers going to do with all this money, right? Let that sink in just one more time, because this is the key to understanding what's happening right now. 15% unemployment, but everybody in the economy receives a 11% raise, more or less, right? Because you may not be working for the company on the corner, but you are getting compensated by the government. So an 11% raise all over. Can't spend it at your favorite restaurant. Can't really spend it at your favorite neighborhood clothing store because you got to stand 6 feet away and it's hard to wear a mask and change a blouse or whatever the case may be. So the consumption statistics within food service places and clothing and accessory stores is depressed because of the mandates, because of the regulations. But where can you shop? You can shop online, and that's been happening. In fact, the amount of online sales as a percentage of total retail sales has doubled over the last 3 months or so, right? So online penetration's gone from 15% of all retail sales to well over 30%. This is completely and totally unprecedented. I think Walmart released their figures, and Walmart's a big retailer, and their online sales were up 97% year over year. And those big box retailers where you can do stuff, I mean, Home Depot sales were up 23% year over year. So yes, there are pockets of the economy that are on lockdown, but those are mandated regulatory lockdowns. Retail overall is doing just fine, thank you. In fact, here's a chart of total retail sales going back to 1994 or so. You see a couple of recessions in there. The recession in 2001 was rather benign. In fact, it took a bunch of years for the BEA to acknowledge that it was a recession. But the great financial crisis was for real, and during that period, it took us 6 years to reclaim retail highs from where we were prior to the great financial crisis. In the most recent experience, it's taken us 3 months. In fact, we just punched 2 record highs. We're 5 months in from the peak. So what took us 6 years before has taken us 3 to 5 months in this go round. And it's not just consumers, businesses sell to consumers. And so this chart is a little wonky, but every month the Purchasing Manager Index survey comes out from the ISM Institute, and they call a bunch of businesses on the phone. And one of the questions they ask them is, do you have more new orders this month than you had this time last month? 65% of the people said yes, okay? Anything over 50% is associated with growth. That's the largest number of yeses that have been deployed since early 2003, I suppose. So businesses are also seeing a surge in demand. And this has been surprising to all the dismal scientists. I've learned a lot during this period. One of the things I will share with you, and this is just an editorial comment, is that most of the people who run money or end up being economists or market soothsayers live in metro areas like New York or Chicago or Los Angeles. Those areas are all really under duress, right? It's been a challenging period with obviously social strife, but they were also the hardest hit by COVID. And I think there's a concept, sociologists, please send me an email thanking me for this, but called geographic determinism, which means that where you are informs your outlook to a large degree. So most of the economists are in areas that would basically make them pretty pessimistic, let's say. Well, they were somewhat optimistic if you look at this chart going into 2020. And by the way, what I'm showing you here is the Citigroup Economic Surprise Index. And it basically registers whatever the expectations are from economists and then whatever the reality of the reports comes in. And if it comes in higher than expectations, this line is rising. If the reports come in lower than expectations, this line is falling. Well, clearly nobody saw the pandemic coming. And so this line collapsed in 2020 as reality came in much worse than expectations. But guess where we are today? Reality, not only is it better than expectations, it's 2.5 times better than it's ever been relative to expectations. I pulled this number today and it's still up around 250. So this has been a great surprise to all of the dismal scientists, economists out there who thought things would be much worse than they are. Maybe we'll have a W, maybe we'll have a square root, maybe we'll have an L, maybe we'll just have an I recovery. One thing I'll share with you, I don't have the slide in this deck, is it's always a V. Recoveries are always a V. So that's what is surprising the economists here, not us as much. All right, so going back to the Asian flu, since this is our best fit comparison, let's recall exactly what happened there with the economy. We saw a 4% drawdown. Again, these are quarterly numbers that they annualize that make them a little bit more substantial. And then a 10% drawdown overall, 3% overall. And then out of that, we saw a substantial recovery with GDP running anywhere from 3 to 9%, really stood up there for quite a while. Absolutely robust recovery. And that was without stimulus, right? This is just animal spirits coming back into play out of a period of darkness. Here's where we are today again. Economy was doing fine. Our natural GDP growth rate now is probably 2.1, 2.3. And then suddenly we got crashed with the coronavirus. Down 5% Q1, down almost 40% Q2 for a 10% total drawdown. I'm picking on Morgan Stanley here. This is their estimate of what GDP will look like coming out of this. So we should have a great quarter that we're in right now, followed by another great quarter, and then above average GDP growth to compensate for what was lost. I think it's underestimated. I think you throw the stimulus in with all of the monetary supply, the fiscal help, and I'll come back to that because that is a wrinkle, with the animal spirits of just the American consumer liberated. And what you'll find is that these numbers are too low. And what happens when expectations come in higher than reality is markets rise, right? That's a critical component. And so if you go back and you look at last quarter, it was an awful quarter for corporate earnings. I think we were down 33% overall, but it was the best quarter ever in terms of expectations being eclipsed by reality. So 85% of companies that reported earnings last quarter beat expectations, and earnings came in 20% higher than people had expected. So it doesn't matter whether reality's good or reality's bad for the stock market. You gotta let that sink in. All that matters is where it is relative to expectations. So if reality comes in higher than expectations, markets are gonna go higher. Well, guess what? Now expectations are rising. So what I'm showing you here, earnings for the S&P 500 in 2019 were $163. All right. They're gonna be hurt in 2020 by what's gone on with coronavirus, maybe $30 or so. But analysts are raising their estimates for earnings this year and starting to raise estimates for earnings next year to the point now where the expectations for next year are higher than where we closed out 2019. And I will say this, Waddell and Associates as a company is running more efficiently and more effectively because of the changes that we made for the coronavirus, right? The technology you're seeing is a little bit of a disruption in the way that we've done business in the past. And you know what? Everybody's acclimated to it, right? We're having Zoom meetings, which means we can be more readily accessible. Maybe I don't fly to Dallas for lunch, so maybe you don't want to own airlines. But the kind of adaptions that people are making is good for the economy overall. It boosts productivity. It is creative destruction. And all of that will boost profit margins as we go forward and surprise analysts. By the way, coming out of recessions, earnings usually surprise going forward, and they tend to be above expectations by about 9%. So these numbers, at least relative to history, are still far too low. All right, now, all the bloat in expectations, the reality coming in better than the expectations has brought us back to new highs. So the question I'm getting most frequently now is it too late? Good question. It is a good question. It's important to understand, at least within the S&P 500, that the majority of the returns have come from 5 stocks. So if you take Facebook, Amazon, Apple, Microsoft, and Google, which are basically the largest stocks within the S&P 500, and these numbers are a few days old. I think Apple was up another 4% today. So up until this point, those stocks had appreciated 35%. Well, they have an outsized influence on the index. They dragged the index up as of this print, which was last week, about 2%. The remaining companies within the other 495 companies within the S&P 500 are barely positive on the year. In fact, as of this, down 5% and still probably below the waterline. So is it too late? Well, maybe for some stocks, but probably not for all stocks. So let's go value hunting to figure out where we can find bargains. Well, large cap US stocks, this is a price to sales metric, which I think is more useful in a disruptive period like this rather than price to earnings, because obviously earnings are depressed. In fact, most high PE ratio periods in history end up being during or right after recessions, which makes sense. So let's get out of the PE business for a second. Let's get into the price to sales business. So if you look at large cap US equities, they're currently trading at $2.4 for every unit of sales. That's pretty pricey relative to its history. Now let's go down and look at small capitalization securities. They're only trading at 90 cents on the dollar in terms of price to sales, which is certainly not an inflated value, especially relative to what we're seeing in US large cap. So you'll hear markets are overvalued, markets are overvalued. Well, you got to sort of break that apart into the components a little bit. The large cap technology stocks on their own are adding 3 points to the PE ratio within the S&P 500 and really influencing it from a price to sales ratio. If you don't want to overpay for something, then you got to go figure out where stuff's on sale. Small caps relative to history are on sale. Also cyclically sensitive. So if we get past this recession, there's an opportunity certainly to make money there, which is why we're there. All right, this is critically important too. This is a chart of the US dollar going back to 1970, which is when we came off the gold standard. And you can see that it really is cyclical, but that the cycles take a while, right? You had this huge spike higher back during the Plaza Accord, and then it came down once we had the Louvre Accord. And then you saw a surge higher going into 2000, and that was a period, if you remember, very similar to where we are today. Large cap US stocks were dominating everything. Everybody wanted to buy the S&P 500. And then it rolled over between 2000 and 2010. And guess what? We became heroes because we owned the emerging markets, and that kind of built, I think, at least a good portion of the balance of the assets that we manage today. So that was a great period to be a global manager. And then in 2011, you got a spike higher in the dollar. It sort of plateaued, but that put a lot of energy behind large cap US stocks. Well, the dollar peaked in 2016 and has been kind of preparing to roll over. And we've seen a rapid decline here recently. It spiked today, but that's just a technical bounce, I think. So what happens when the dollar rises and what happens when the dollar falls if you're a global investor? In years when the dollar is up, the S&P 500 going back to the 70s advances about 10, 11%. Okay? Foreign stocks in years when the dollar is up go up about 2%. Emerging market stocks go up about 3%. So when the dollar is rising, it's tough if you're a global investor. However, the dollar is cyclical. So what happens when the dollar falls? Well, when the dollar is down, it's actually good for the S&P 500 a little bit because the US basically goes on sale. But if it's down, that means foreign currencies are rising, which if you invest in foreign securities gives you an extra amplification on returns. So years when the dollar is down, foreign stocks on average are up 19%. The emerging markets are up 22.5%. So if you think we've entered a period where we could see dollar depreciation, we've got a $4 trillion deficit now. We've still got a sizable trade deficit. Obviously, we've got political discord, and you're starting to see some of these other currencies, especially in nations that didn't have as big an outbreak as we had in the US, like Germany and the euro, start to tick higher. So if you think we're in a cycle where you could see the dollar decline for a number of years, then you definitely want to tilt your portfolio towards emerging markets and take advantage of some of that. Well, that only works if the valuations are attractive. Here is a smooth out version of valuation in the US going back to 10 years. So you basically take 10 years worth of earnings, you divide the price through it. This is what Schiller uses, if you will. And as you can see, we're at the highest level we've been since, we're at the highest level we've been since the late 2000s, the late 1990s. So the US markets, while not at the nosebleed levels we were at then, are definitely pricey compared to history. Where is the developed market? Think Europe, think Japan, think Australia relative to the US. Well, it's at the lowest level it's been in 35 years. What about the emerging markets? Also, the lowest level they've been in 35 years. So you may have a compounding effect where you've got the dollar rolling over, you got more attractive valuations overseas, you've got the US, which is, an over-owned large cap US technology bucket. And if those assets go looking for a home, there's substantial returns to be had down the cap spectrum and offshore. Now, this is a chart I want to spend a little bit of time on. This is the market going back to 1930. Okay? I'm picking the S&P 500. We move in secular cycles. We have these little cyclical things. And by the way, I mentioned earlier the drawdowns in markets during certain pandemic periods. On average, the market falls from its highest point in any given year about 14%. So you don't get through a year without a drawdown. It could be a 30% up year, but you might have a period where you get a dramatic drawdown, a dramatic advance, et cetera. So if this year, think about it, ends up being 10% positive, the history books will say, well, you had a 40% drawdown. The end of the year, 10% positive. So you're going to have drawdowns in any given year. But we're in a secular bull market, have been in a secular bull market. Here's what that looks like. So if you look at the period 1930 to 1950, we were in a secular bear market. So for that 20-year period, the market actually declined 22%. Then we kicked into a secular bull market for the next 20 years. The market went up 452% over that period and printed 365 new all-time highs. Over the next 10 years, we were in another bear market period during the 70s. I could go into lecture as to why, but the market overall advanced a paltry 17% in 10 years and only punctuated highs 35 times. And then we got into the go-go days, the 1980s to 2000s. Nothing like that's ever been seen before. The market was up 1,200%. You had 500 new highs. And then obviously that crescendoed at the end of 1999. We went into 10 years of a bear market cycle with the market down 24% into 2010, and we only hit 13 new highs. And then we started the secular bull that we're in now, that so far has printed 255 highs and gone up 178%. So you had 20 years of a bear, 20 years of a bull, 10 years of a bear, 20 years of a bull, 10 years of a bear, and then maybe we're in 20 years of a bull, I don't know. But this analysis, and based upon what I see in the cap spectrum valuations, with all the stimulus we've got afoot, suggests to me, especially with all that money supply that's washing around looking for higher returns than you can get in money markets, that this secular bull is not over, and that COVID is just a drawdown in a much longer bull market phase. All right, so here's my bottom line. The COVID outbreak triggered two things: the fastest stock market sell-off in history and the worst quarterly GDP drop in US history. Down 38 on the market, down 33 for GDP, and elected officials had to respond, and they responded at historic degrees. So we got record monetary support with the $3 trillion we've already seen. They've tapered that a little bit now, but $3 trillion in money printed, $4 trillion in guarantees, $7 trillion in monetary support is what came out of the Fed. In terms of fiscal support, we've seen $3 trillion so far in fiscal support, and the Democrats would like to see another 3. The Republicans are like, let's just do 1. 1 matters. 1 is 5% of GDP. So they're arguing over whether it should be 1 or 3. Either way, if we only get $500 billion, it's still a substantial infusion into the economy. So it's going to be $3 trillion plus, even if you just count Trump's executive order. This has led to an absolutely record-breaking recovery pace, right? This is the fastest stock market recovery in history. Yes, we're up 50% from the lows, but guess what? The average stock market run after a recession is 100%. So is there still runway here based upon the stats, based upon history, using probability theory? The answer is there's still room to run. This is the highest economic surprise readings in history by a factor of 2.5x, and it's the highest estimated GDP growth in history. So I actually went and looked 2 days ago. The Atlanta Fed, which puts out GDP Now, which is, if you Google it, a great way to figure out what the Fed thinks GDP is going to do, printed a 25% expectation. So remember I had Morgan Stanley at 20? The Fed just came out and said, oh, we think it's going to be 25. Again, underestimated. So we've got that in the system. That's what we're experiencing right now. And guess what? We don't have a vaccine. So imagine the power of a vaccine with all of this going on in the background. So the bottom line is, left to our own natural devices, this economy was going to recover. It was going to expand. Now, the government put mandates on us that they did not in previous pandemics, and they compensated us for that with stimulus. I will argue that the stimulus is larger than the impact that the forced shutdowns ended up having, and therefore they just added fuel to what will be a raging fire once we get on the other side of this. So it's an optimistic scenario. I reserve the right to change my opinion should the facts change. But for the moment, the question is, will all of this work? The answer is absolutely. And I want you all to be safe, but enjoy your recovery. So those are my formal remarks. We may have some questions, and I think I did that in 50 minutes, Karen, so real proud of myself.
That's pretty good. Thank you, David. That was fog cutting at its finest. And we do appreciate all the work you put into this and your outlook. We do have some questions. We actually have a simple one. What is SAR, S-A-A-R? If you could elaborate.
Seasonally annual adjusted rate.
Right, excellent. We have a few more questions too. There were a couple based about the election. So what does the election, assuming a blue sweep, mean for the market?
So I am balanced, right? I'm not always a raging bull. What I was afraid of is, to a certain extent, percolating right now. We do have an election coming up. I'm not really talking about which candidate's going to be elected, whether it's Biden or Trump. But the gamesmanship going up to that election has created paralysis on the second tranche of stimulus. You can't tell people they can't do business by law and then not provide some sort of compensation in exchange. So the gridlock that we're seeing around this second tranche of stimulus is concerning. That concerns me more than who gets elected on November 4th. If we don't do anything about unemployment benefits, if we don't receive another $1,200 check, and I'm not sure that's necessary, but it'd be nice. I didn't get one, but it would be nice. Then the 11% unemployment rate, or it's really 10.2% unemployment rate that we have right now will translate. So that personal income up 11% will start moving naturally towards that down 5%, down 7%. That's bad, right? So if you're going to mandate that people can't go to work, then provide them money in exchange. Without that money in exchange, you could invite an echo recession. Now, I don't think that's going to happen. I do think we're going to get stimulus, but it concerns me that all the gerrymandering ahead of the election is taking its toll, and it's taking longer than it needs to see that money hit the economy. And then once I think we get that tranche of stimulus, the election happens, it matters maybe at the margin in terms of how people feel. When the incumbent wins, markets tend to advance 5% in advance of that. When the incumbent loses, it tends to sell off 5% in advance of that. Those aren't huge numbers, but if you get the stimulus and then you get the vaccine, then you're going to see that hockey stick higher in GDP growth, at least for a while. So I'm not as worried about election day. I'm a little bit worried about the way that the games are being played prior to election day to try and curry favor with the populace, because we need that stimulus, and it doesn't matter whether it's $1 trillion or $3 trillion, we just need it.
Mm-hmm. There's another question here that I think you already touched on. Why such a disconnect between stock market and the economy?
Yeah, and there's another way for me to say that. If you walk down the street, and I'm in Nashville today, you can see the damage. I mean, there are small businesses that are shuttered. There are signs on their door saying, "We're sorry, we love you, but we're out of business." It's sad. It's really sad. So the micro economy in the US and the stuff that you see, your favorite restaurants, et cetera, are really in duress, and they're being forced to close. Yes, maybe we wouldn't go in there naturally as consumers, but I think there's less of that than there is the mandate to stay away, the bars, the entertainment venues, et cetera. That is super visible stuff, super visible. But within the S&P 500, if you add up all the profits from airlines, hotels, and all the things that are affected by COVID, it amounts to 7% of the profit in the S&P 500, right? And those are the large companies who are surviving, and some of those will get bailouts. So it's a huge portion of employment, but it's not that big a portion of profits. Any of you out there who have ever owned a restaurant or invested in a restaurant know it's a tough business, not high profit margin. So what we're seeing on Main Street is the damage that's happening. But when you look at that in context of the entire United States economy, it's actually a smaller figure than it appears. So I'm an entrepreneur, big fan of entrepreneurs. This is the worst period for small business I think I've ever seen. And I'm very worried about the disparity between large and small profits and prosperity going forward. But in reality, Microsoft makes a whole lot more money than all of the restaurants do. So that's why the market's doing so well, and Main Street looks like it's closed for business.
We've got a couple more questions here. Can you offer more explanation on the impact of the vaccine? It says here the Pfizer COVID vaccine will go for approval in October. Say it's approved, what happens?
So I was in, I took my son on a road trip, right? The Great American Road Trip. Camps were closed. So I said, kids, each of you get 1 week in the car with dad. Tell me where you want to go. My daughter said she wanted to go to Florida. So we're the reason why Florida closed for a second time, I think. And my son wanted to go out west. And so we ended in Vegas, okay? And we spent one night at the Bellagio before we got on a plane early the next morning and moved on. The Bellagio is allowed to have 65% occupancy. It was sold out. So which is it? Is the Bellagio only operating at 65%, as CNBC would tell you? Or is the Bellagio sold out?
Right.
So I think the biggest impact of the vaccine, if we can get to scale from a production standpoint, is all the restrictions go away. And once the restrictions go away, I believe that you will find that people will go circulate. Let's go back in history again to 1957, when that vaccine was only 60% effective and the economy was growing at 9%. So the vaccine is what will release people without restriction back into the marketplace. And by the way, I have this slide in the deck if you want to go into extra innings, but the US savings rate right now per person is 30%. So a lot of the money that we've received, we haven't spent, right? Out of fear or because it just showed up. But there's still plenty of dry powder out there. So a vaccine unlocks the business restrictions, unlocks that dry powder, enables people to participate, and they will with a vengeance. At least that's what happened in history, right? Maybe we're different this time, but I don't think so.
And maybe just, let's see how we're doing on time. Maybe just one more question.
Sure.
What is the near-term outlook for small business? Will commercial real estate and hospitality industries come back?
I think that's all contingent on the vaccine. I think it's tough. Now, I will say that if you can survive this period, or you can use this as an opportunity, if you've got balance sheet strength, you should buy up as much market share as you possibly can, right? Because there will be fewer players. There will be lots of revenue. There's plenty of cash rolling around. So recessions, and that's what this was. I mean, it was COVID inspired, but in its core, it's a recession. Recessions cut out the weak and enable the strong. So our advice to business owners right now is play offense, right? The time to play defense is past. So if you've got the wherewithal, it's time to play offense. And the small businesses, it's a challenge. It's a real challenge because they don't have the access to credit that the large businesses have. Now, there should be another tranche of PPP on the way. The criteria to receive it is that your revenues will have to be down 35% year over year, so that makes it kind of tough. But there is credit available to small businesses. But my suggestion to the people who are surviving is be aggressive. You know, go hire the people you want to hire. Go buy the competitors who may be in distress. This is a time to really start playing offense. And those who do will be rewarded. And for those who are, you know, struggling to survive, you got to figure out how to pivot. The whole world goes online. So it's sort of an innovate or die, which is sort of a sad scenario right now. But we've got some clients, and I'm so proud of our clients, by the way. We've got some that are in very distressed industries. And the things that they have done to innovate and be relevant, even with the restrictions upon their industries, is just astounding, right? So the other thing a small business can do that a large business can't do is it can move quickly. It can reinvent itself overnight. We could be David Waddell's coffee stand tomorrow if we decided to at Waddell & Associates, and I do love coffee. But I think Starbucks may have a handle on that. Nonetheless, so pivot if you can, become relevant, or gobble up your competitors if you got the balance sheet strength.
David, that's great information. That's really all we've got time for. We are right up on 4 o'clock. So thank you all for tuning in. I hope you all enjoyed it. As I said earlier, we will be emailing the replay of the call. So do check your inbox on Sunday morning and forward it on if you know someone who needs some clarity in their lives. We will be sure to respond to all of the other questions that we got and didn't have time for. But again, if you have additional questions, either reach out to your wealth strategist or send us an email directly at request@waddellandassociates.com. Thank you so much and have a great weekend, everyone.
Thanks, everybody. Thank you.